Well, good morning, everyone. It's August, 14th? I can't keep track of the days. The summer's just moving so fast. I have no idea where summer has gone. My kids are already gone back to school. It's just nuts. All right. Bad news this morning. Yield curve. We have inverted yield curve on the bonds. And this is after the market rallied over 400 points after Trump decided to push back tariffs several months. This is not good news. As a matter of fact, inverse yield curve has preceded 9 of the last recessions. Now, it doesn't mean we're going to have a recession tomorrow. It may mean we may have one in 2 years, but this is not great news. Now, what does this mean? And I highlighted it for you here so you can actually look at the numbers while I'm speaking. But typically, the longer the bond time period, the higher the yield. And that makes sense because there's more uncertainty 10 years down the road than 2 years down the road, okay? Kind of makes sense. So typically, the longer the period, the longer the bond is open for, the higher the yield, the higher the reward. Well, what happened overnight is the 2-year bond has overtaken the 10-year bond in terms of the interest rate that it's yielding. So right now, the 10 years yielding 1.622%, while the 2 years yielding 1.634%. And the last time we had this happen was right in 2005, about 2 years before the recession. So again, it doesn't mean we're having one now, but it's a warning sign, and it's not a good warning sign. And again, these inversions don't happen very often. And it's not a good sign. The market's down about 400 points before the open. Let's take a look at the futures. So we can get through some numbers. Yeah, the Dow's down about 394 points pre-open. And if we look at the S&P, this is the E-mini pre-open, okay? Let's go to 9-month. Yeah, that's fine. You could see the 50-day moving average here, and you could see the 200-day moving average here. Let me reduce the time period. There we go. And right now we're trading right around the 28.89 level. Now, the number that I'm looking at is 28.65. If we break 28.65, there's a good chance we're going to hit the 200-day moving average. As a matter of fact, the way price action's moving right now, there's a fair chance we're going to hit the 200-day moving average before coming back up. And obviously, China has some impact in all of this because pushing back tariffs doesn't mean we're not going to have tariffs. It's just pushing back the inevitable. But the inverse yield curve is not a good sign. It's not a good sign when investors are seeking interest on 2-year notes instead of 10-year notes. It means they're more scared about the future of the economy, which makes sense. So again, China has a big part in all of this. If the recession agreement, if we do away with the tariffs, it'll go a long way. Again, this is a warning sign. It doesn't mean there's going to be a recession tomorrow. It just means that there may be one in the next couple of years. Now, again, keep your eye out on the 2864 level on the E-mini S&P, and keep your eye out on the 200-day moving average at 2800 level. Let me look at the SPY so you can look at this intraday as well. Exciting volatility. The level on the SPY is 286.93, right around that level. If we break 290, 287, high 286s today, it's not going to be pretty. The odds are we'll head down to the 282 area, and that'll probably push us to the 200-day moving average, which is at 279, 280 level. So again, keep your eye out for the high 286 level, the 281.60 level, and the 279, 280 level. I don't think we're going to break through the 200-day in the next few weeks. I think we're going to bounce off of it just like we did over here before the summer started, shortly before the summer, or right when summer started. But I think we're going to test the 200-day, or at least the 281, 282 level. Again, inverse yield curves are not pretty. But again, it's a warning sign. It's not a certainty. So keep your eye on that. I don't want to alert you. And remember, I don't want to panic you. I want to alert you. I don't want to panic you. But again, this is a long-term indicator. And I think it has a lot to do with the trade war and lack of its resolution. I'll talk to you guys tomorrow. Take care.